everyone? Welcome to the Stock Market Morning Prep video for Tuesday, May the 20th. Well, we got a little follow-through from Friday, late Friday's rally. Markets were down at one point about 9 S&P handles early in the morning session, and right out of the gate at 9:30, buy programs came in, and algorithms and high-frequency traders came in and pushed the markets higher on absolutely no volume. So does that validate the move? I believe not. I'm a firm believer on volume confirms price. However, that doesn't mean that you go out and short the market. We have not had a short signal yet, although there are tons of warning signs. I think the markets are extremely vulnerable here. And what I'm going to do is just take a step back and look for the best trading opportunities they are. And if you really are looking at the screens during the course of the trading day, you'll notice that a lot of the stocks aren't moving. They're just the indexes are moving. And as well, we have market divergence. As you know, we had the aside from yesterday, we have the Russell and the Qs rallied yesterday, but on dismal volume. Transports made new highs yet again, and I do believe that that's really what's kind of holding it up, along with the S&P and the Dow, without having some decent selling. Now we're into the last 2 weeks of May, so the sell in May, go away has not materialized, and it is just a saying, but we do. It is a seasonal time of weakness, and that has not materialized yet. So that's why we just don't go out and short the market. You can short weak stocks, obviously, relative weakness to what the market is doing, if you are looking for a short trade. Me personally, aside from a few swing trades, I would not be holding a large book of longs at these levels. Markets can absolutely make new highs, but I do think that if that were to happen, I think you're going to see a lot of sellers come back in at this area. I keep mentioning the fact that we do have market divergence with many warning signs, and that's just not the way I like to trade. So just please, guys, use a word of caution here, okay? When you have the yen ticking higher and bonds ticking higher with no sell-off in sight, that's just a huge warning sign. And until that happens, until that does change, I'd be more than happy to buy the market with two hands, but I'm not going to do so until this market realigns itself, okay? So a word of caution, and what I'm seeing, I just like to point it out to you. So let's go right into the charts. We have the Japanese spot yen. As you know, it's inversely correlated with U.S. equities. We are now have this nice large inverted head and shoulders I've been showing you along with this ascending trend line. We're looking to break this neckline here. But again, we have this cluster of Fibonacci cluster with the 200s. So that's going to take a little bit of time before it breaks out. But if that does break out, then I'd say be careful, because the markets will take note of that. Now we go to the bonds. As you know, we have this large, also inverted head and shoulders pattern with the slanted neckline, which we broke out already. I did put a Fibonacci extension of the 1272 extension I showed you yesterday in the video, and then we also have the 1618 that coincides nicely with the head and shoulders target of the 142.27 in the bonds in the ZB. That's the 30-year. So just a word of caution. As you can see, we've been getting light volume pullbacks, which is bullish, and we have explosive moves with heavy volume to the upside, which confirms accumulation. So money is definitely flowing into the bond sector. So that's what really, out of everything else, that's what really concerns me. Now we take a look at the ES. Now, if you looked at it, we have gone nowhere. In April, we have gone nowhere. We've literally have a 20-something handle move in the S&P, gone nowhere, just underneath the 1272 extension. Pretty much all of March, but we did get some volatility in mid-March where we did break down below that. But you can see here we've gone nowhere. And we're still holding that 1272 extension. Can we get to the 1618? Absolutely. And again, if you're going to short stock, short relative weakness to what the market is doing. I wouldn't short the indexes here. But if we ran hard into that 1918 area, I definitely would be a short selling candidate to be shorting at these areas here. Because as you can see, if you go back, the markets are fairly valued. There's nothing to the markets at the moment here other than the market's just grinding higher and having the algorithms here really taking hold of this marketplace right now, because we have no volume. You can see there's absolutely anytime all of this move up, no volume. This little tiny move up, this 4-day move up, no volume. And then look at this move here, no volume in the last 3 days. Absolutely dismal volume. Probably one of the slowest days of the year so far. And we haven't even gotten to the summer yet. Dow Jones up 21 points, no big deal from yesterday. As you can see here, we dropped from Friday, no volume. So yesterday's move on no volume doesn't really bode well for me, and I am not a believer of this rally. Now we can rally higher, absolutely, and look at the transports. Transports actually picked up volume on yesterday. So is it okay to own, UPS and FedEx? Absolutely. I would definitely do so, but I would not be doing it. On any other stocks looking to pick bottoms here. Some other sectors are looking pretty good, and I'll get into that with you in a moment. But transport's making new highs, and that really is our leader. So can one sector, can one indice, hold up the market? I don't know for how long, but it can at least buoy the market at one point until the market starts to get tired here. So making new highs yet again yesterday, decent volume, but still way below the average of the 50. So again, I'm using a word of caution here, okay? And then take a look at the IWMs. Dismal volume, well below average on the 2-day rally here, and even dropped on Monday. But again, you're going to have these oversold rallies. But if this is bullish to you, I don't know what is. This is a very bearish chart. Lower lows, lower highs. We have bearish configuration on all the moving averages, and we're still below the 200 SMA. So again, guys, word of caution here. And lastly is going to be the Qs. We are now out of this downtrend channel, which is bullish, but look at the volume again. Absolutely dismal. So, some market technicians say, oh, volume doesn't matter anymore. I absolutely agree. I disagree that volume does matter. It's very, very important here, okay? So anyway, I want to just point out a couple of things. I'm getting to like some of the software sectors, the IGVs, the ETF. Also, there's some networking, the IGN, FFIV stands out really nice, and CRM is reporting, so keep an eye on that. Red Hat is looking, RHT is looking enticing for another big move. So I do like some of that beaten down sector, but it's going to need a little bit more work. So just keep that in mind, okay, guys? I wouldn't want you to be picking a bottom here. So let's see what happens, and then we'll go from there. Let the market digest some of this intraday divergence and see if the markets can realign itself, and then you can go at it with with two hands and start buying stocks. But right now, I'm taking it easy. I want to find the best setups, and I'm not finding it. Believe it or not, I am not finding it at the moment. But things are going to open up and things will change, no question about it. But if we start looking at some of the stocks that have sold off, some of the sectors that have sold off, that will definitely create a better buying opportunity than stocks that are at 52-week highs where the markets are at its all-time highs. I would not be touching that sectors at all. All right? Have a great day. Hope it helps, and we'll see you tomorrow. Take care.